Have you ever walked into your bank, moved some money around, and never given it a second thought? Most of us have. After all, if you've spent decades working, saving, paying taxes, and building financial security, it feels perfectly reasonable to assume that you can move your own money whenever and however you want. And in many cases, that's true. But here's something that surprises a lot of retirees. Sometimes a completely innocent banking transaction can attract attention from systems designed to look for fraud, tax evasion, or suspicious financial activity. You may have done absolutely nothing wrong, yet certain transactions can still trigger questions, additional reporting requirements, or even unwanted scrutiny from the IRS. Now, before your heart starts racing, let me reassure you of something important. This doesn't mean you're in trouble. It doesn't mean IRS agents are showing up at your front door. And it certainly doesn't mean you should be afraid of using your own money. What it does mean is that understanding a few basic rules can save you a tremendous amount of stress, confusion, and paperwork later. And honestly, isn't that what retirement is supposed to be about? Less stress, more peace of mind, more time enjoying your family, your hobbies, and the life you've worked so hard to build. Today, we're going to talk about 7 banking moves that often trigger IRS attention. More importantly, I'll show you exactly how to avoid problems while staying completely within the rules. Some of these may surprise you. A few might even sound familiar. And 1 or 2 could save you from making an expensive mistake. So grab your coffee, settle into your favorite chair, and let's walk through this together. Let's start with the first banking move that catches many people completely off guard. Number 1, breaking up large cash deposits. Imagine this. You finally sell that old RV that's been sitting in the driveway for years. Maybe it's a fishing boat. Maybe it's a classic car you've treasured for decades. Whatever it is, the buyer shows up with cash, a lot of cash. You count it out and realize you're holding $12,000. Now, suddenly, you're thinking about the stories you've heard. You've probably heard that banks report cash transactions over $10,000. And then a seemingly logical idea pops into your head. Maybe I'll just deposit half today and the other half later. It sounds harmless. In fact, many people think they're actually helping the bank by avoiding extra paperwork. Unfortunately, this is where good intentions can create unnecessary problems. The government has a name for intentionally splitting deposits to stay below reporting thresholds. It's called structuring. And here's the important part. The government doesn't just look at what you deposited, it looks at patterns. Modern banking software is incredibly sophisticated. It doesn't simply monitor individual transactions. It analyzes behavior. If someone deposits $6,000 on Monday and another $6,000 on Thursday, those transactions don't exist in isolation. The system sees the entire picture. To a computer programmed to detect suspicious activity, those deposits may appear as an attempt to avoid reporting requirements, even if you were doing nothing wrong, even if every dollar came from a perfectly legitimate sale, even if you simply didn't know the rule. That's why trying to stay under the radar can actually attract more attention than being transparent. The smarter approach is surprisingly simple. Deposit the entire amount. Let the bank complete the required reporting. The paperwork is routine. Bank employees handle these reports every day. It doesn't automatically create a tax bill. It doesn't mean you've done something wrong. It's simply documentation. Think of it this way. When you've earned money honestly, transparency becomes your greatest protection. You don't need tricks. You don't need workarounds. You don't need to outsmart the system. You simply tell the truth and move forward. That approach creates far fewer headaches in the long run. Now let's move to the second trap, and this one affects a lot of loving grandparents. I call it the generous grandparent surprise. One of the greatest joys of retirement is being able to help the people you love. For many retirees, there's nothing more rewarding than watching children and grandchildren build their lives. Maybe your granddaughter is buying her first home. Maybe your grandson is starting a business. Maybe a family member needs a little financial help during a difficult period. And because you've planned carefully and saved responsibly, you're finally in a position to help. It's a wonderful feeling. You transfer $25,000 to help with a down payment. You feel proud. They feel grateful. Everyone celebrates. End of story, right? Not quite. The IRS has specific rules regarding gifts, and many people misunderstand them. The first thing to understand is that making a large gift does not automatically mean paying gift taxes. This is where a lot of unnecessary fear comes from. People hear gift tax and immediately imagine writing a huge check to the government. In reality, most Americans will never pay federal gift taxes during their lifetime. What often happens instead is that larger gifts simply require additional reporting. For 2026, the annual gift exclusion allows you to give a certain amount to an individual before reporting requirements apply. When you exceed that annual amount, you're generally required to file additional paperwork. But filing paperwork and paying taxes are two completely different things. That's an important distinction. Think of the paperwork as simply informing the IRS that a gift occurred. For most retirees, it doesn't result in an actual tax bill. Another valuable planning opportunity exists for married couples. If you're married, you and your spouse can often combine your exclusions through a process commonly called gift splitting. This allows families to transfer substantially more wealth to children or grandchildren while remaining within IRS guidelines. The lesson here isn't don't help your family, it's exactly the opposite. Help them, be generous, share the rewards of your hard work. Just make sure you're following the reporting rules so your generosity doesn't accidentally create confusion later. Now let's talk about one of the most expensive mistakes retirees can make: the 60-day IRA rollover mistake. This one deserves your full attention. Because unlike some of the other situations we've discussed, this one can create a real tax problem. Imagine you're changing financial institutions. Maybe you found a broker with lower fees. Maybe you're consolidating accounts. Maybe you're simplifying your retirement finances. All reasonable decisions. You request a distribution from your IRA. A check arrives. You deposit it into your checking account. And then life happens. You get busy. There's a family trip. A grandchild has a birthday. You need to deal with home repairs. Days turn into weeks. Weeks turn into months. And before you know it, that retirement money is still sitting in your checking account. This is where the danger begins. Once retirement funds are distributed to you personally, a countdown starts. The IRS gives you a limited period to redeposit those funds into another qualified retirement account. Miss that deadline, and the consequences can be severe. The distribution may become fully taxable. A transaction that was supposed to be a simple rollover suddenly becomes taxable income. For some people, that could mean thousands of dollars in unexpected taxes. The truly frustrating part? Many retirees never intended to withdraw the money permanently. They were simply trying to move it. That's why financial professionals overwhelmingly recommend direct transfers whenever possible. A direct rollover removes you from the middle of the process. Instead of receiving the money personally, one institution transfers the funds directly to another. No countdown, no accidental delays, no risk of forgetting, no unnecessary stress. Sometimes the simplest solution is also the safest one. And when it comes to retirement accounts, direct transfers are often exactly that. Now let's talk about something that's becoming increasingly common among retirees: side hustles and payment apps. Retirement today looks very different than it did a generation ago. Many retirees aren't slowing down completely. They're consulting, selling collectibles, teaching classes, creating crafts, tutoring, doing freelance work, or turning lifelong hobbies into small sources of income. And honestly, I love seeing it. Retirement doesn't have to mean stopping. For many people, it means finally having the freedom to do meaningful work on their own terms. But modern payment apps have introduced a new layer of complexity. Money arrives through digital platforms. A payment appears on your phone. You move on with your day. It's convenient. It's fast. And sometimes it's easy to lose track of what is personal and what is business related. Think about how many transactions flow through payment apps today. A friend reimburses you for dinner. Your daughter sends money for concert tickets. You receive payment for selling an antique lamp online. A consulting client pays an invoice. A neighbor buys one of your handmade woodworking projects. Before long, personal transactions and business transactions can become tangled together in ways that make record keeping difficult. And that's where problems often begin. The challenge isn't necessarily the amount of money. The challenge is documentation. When tax forms are generated, the IRS only sees reported numbers. They don't automatically know which payments represented income and which payments were simply friends or family sending money. Without good records, it can become difficult to explain the difference. And let's be honest, most retirees don't want to spend their retirement sorting through hundreds of digital transactions trying to remember what happened 6 months ago. That's why one of the smartest financial habits you can develop is keeping business and personal activity separate from the beginning. If you're earning money from a hobby, consulting work, tutoring, selling collectibles, or any type of side business, consider creating a dedicated account specifically for those transactions. It doesn't have to be complicated. It doesn't need to be expensive, but having clear separation creates clarity. And clarity is one of the most valuable things you can have if questions ever arise. When tax season arrives, you'll know exactly where your income came from. You'll know exactly what expenses relate to your side business, and you'll avoid the frustrating process of trying to untangle personal transactions from business activity. Now let's move to a topic that surprises many retirees who enjoy spending time abroad. I call this one the snowbird foreign account oversight. For many people, retirement finally creates the opportunity to travel more. Some purchase vacation properties, others spend winters in warmer climates, some split their time between countries. Maybe you've purchased a small condo in Mexico. Perhaps you spend summers in Europe. Maybe you've fallen in love with a quiet coastal town somewhere outside the United States. To make life easier, many retirees open local bank accounts. It's practical. You need a place to pay utility bills. Property maintenance fees need to be paid. Local expenses become easier to manage. Nothing unusual about that. Unfortunately, many people assume that because these accounts are small and used only for convenience, the government isn't interested in them. That's where trouble can start. The United States has reporting requirements involving foreign financial accounts, and these rules apply whether the account is being used for investments or simply to pay everyday bills. The mistake many people make is assuming that a small account isn't important enough to report. But reporting requirements are based on specific thresholds and rules, not personal opinions about whether an account seems significant. What makes this especially tricky is that the threshold applies to the combined value of qualifying foreign accounts. In other words, multiple accounts can collectively trigger reporting requirements. And the government takes these filings seriously. The reason is understandable. Authorities have spent decades trying to combat offshore tax evasion and hidden foreign assets. Unfortunately, retirees with perfectly innocent accounts can sometimes get caught up in rules originally designed to target something entirely different. The good news is that avoiding problems is relatively straightforward. Keep accurate records. Monitor account balances. Understand reporting requirements. And don't assume that an account is exempt simply because it's used for ordinary expenses. A few minutes of attention each year can prevent enormous headaches later. More importantly, it allows you to enjoy your travels with confidence instead of worrying about whether you've overlooked an important filing requirement. Now let's discuss a retirement rule that affects millions of Americans every year: required minimum distributions, or as many retirees simply know them, RMDs. If you've reached the age where RMDs apply, you already know they're not optional. The government eventually wants to collect taxes on money that has been growing tax deferred for years or even decades, and that's perfectly understandable. You received valuable tax benefits while saving. Eventually, the bill comes due. The problem is that life gets busy. Retirement may be less hectic than your working years, but it certainly isn't empty. There are family gatherings, doctor appointments, travel plans, volunteer activities, grandchildren, home projects, community events, and before you know it, another year has nearly passed. I've spoken with retirees who fully intended to take their required distribution. They knew the rule, they understood the deadline, but somehow December arrived faster than expected. One distraction led to another, and suddenly they found themselves scrambling. The IRS takes missed RMDs seriously because these distributions are expected and predictable. Financial institutions report information. The government generally knows when distribution should be occurring. That's why failing to take an RMD can quickly attract attention. Even worse, penalties can be significant. Imagine paying a substantial penalty simply because something slipped through the cracks during a busy holiday season. That's not how anyone wants to spend retirement. Fortunately, technology provides an easy solution. Automation, one of the most powerful financial tools available today, is the ability to automate important tasks. When something is automated, it doesn't depend on memory. It doesn't depend on motivation. It doesn't depend on whether you're busy. It simply happens. Many financial institutions offer automatic RMD services. They calculate the amount, schedule the withdrawal, handle the transfer, and in many cases, even assist with tax withholding. The result is peace of mind. Instead of worrying every December, you know the process is already taken care of. And peace of mind is worth a great deal in retirement. Now let's move to our final banking move. And this one is becoming increasingly common. Mixing side hustle income with personal finances. At first glance, this seems harmless. Maybe you're earning a few $100s a month tutoring students. Maybe you're selling handcrafted furniture. Perhaps you're consulting occasionally in a field where you've built decades of expertise. The payments arrive. You deposit them into your primary checking account. After all, that's where your Social Security arrives. It's where your pension arrives. It's where your investment income lands. Why not put everything in one place? The answer comes down to organization and potentially protection. When business transactions and personal transactions occupy the same account, they create a complicated financial trail. Imagine trying to identify business-related income from hundreds of unrelated deposits, a reimbursement from a friend, a birthday gift, a transfer between accounts, a consulting payment, a family loan repayment, a pension deposit, a woodworking sale. Now imagine trying to explain all of those transactions to someone reviewing your finances years later. You can see how things become messy quickly. Financial professionals often refer to this as commingling funds. And while it may seem like a minor bookkeeping issue, it can become a major inconvenience if questions ever arise. A dedicated business account creates a clean separation. Income goes in, business expenses come out, records stay organized, everything becomes easier. Tax preparation becomes simpler, expense tracking becomes simpler, documentation becomes simpler, and perhaps most importantly, your personal financial life remains separate from your business activities. That separation can save countless hours and eliminate unnecessary stress. Now, after hearing all 7 of these situations, you may be thinking something important. Wow, there are a lot of rules. And you're right, there are. But here's the encouraging news. Notice that almost none of these situations involve people doing something dishonest. Most involve good people making innocent mistakes. They're helping family, moving retirement accounts, selling personal property, traveling, running small side businesses, living their lives. The real lesson isn't that the financial world is dangerous. The lesson is that a little knowledge goes a long way. Retirement should be a season of confidence, not fear. You worked hard for decades to build financial security. You sacrificed, you saved, you planned, you delayed gratification when others were spending freely. You earned the right to enjoy this chapter of life. And part of protecting that enjoyment involves understanding a few basic financial rules. The retirees who experience the least stress are usually not the ones with the most money. They're the ones who stay organized. They keep good records. They ask questions when they're uncertain, and they address small issues before they become big ones. That's really the common thread running through everything we've discussed today. Transparency, organization, simplicity. When you deposit cash honestly, maintain proper records, separate personal and business finances, follow retirement account rules, and complete required reporting, you dramatically reduce the chances of unpleasant surprises. And isn't that what we all want? Less uncertainty, less paperwork, less worry, more freedom, more confidence, more time spent focusing on the people and experiences that truly matter. Because at the end of the day, retirement isn't about constantly looking over your shoulder wondering if you've made a mistake. It's about enjoying the life you've spent decades building. It's about family dinners, vacation memories, grandchildren's milestones, morning walks, coffee with friends, volunteer work, travel adventures, and all the little moments that make this stage of life so meaningful. The goal isn't to become a tax expert. The goal is simply to understand enough to stay out of trouble and keep moving forward with confidence. So before we wrap up, let me leave you with one final thought. Whenever you're about to make a significant financial move, pause for a moment and ask yourself a simple question. Is there any paperwork or reporting requirement I should know about first? That one question alone can save you from countless headaches. And if you're ever unsure, don't guess. Reach out to a qualified tax professional, financial advisor, or your financial institution. A 5-minute conversation today can prevent months of frustration tomorrow. Thank you so much for spending part of your day here with me. I truly appreciate your time because I know there are countless ways you could be spending it. If today's discussion helped you feel a little more confident about protecting your retirement savings, then that's time well spent. And remember, smart retirement planning isn't about being perfect. It's about being informed, one good decision at a time, one smart step at a time, and one peaceful year after another. Until next time, take care of yourself, take care of your loved ones, and continue protecting the financial future you've worked so hard to build.